Welcome to your Mortgage Insider Update for February the 9th. This week we get a little delayed action from the Bureau of Labor Statistics with the January jobs report. Originally it was due out last Friday, but the short government shutdown delayed it. We did get the JOLTS report, which is job openings last week, which took a little bit of a tumble on the stock market and helped interest rates on Thursday when a significant drop in available jobs, 750,000 less jobs than originally thought, from 7.2 million to 6.5 million jobs in a week that we also had an elevated number of new unemployment claims on Thursday. So that leaves us with waiting just a little bit this week to Wednesday to get the jobs report from January. The ADP report came in a lot weaker than expected. So a negative jobs report, loss in jobs, or anything less than 70,000 jobs reported from Bureau of Labor Statistics, and any tick up in the unemployment rate will start to fuel speculation around when the Fed might cut interest rates again. Currently not expected until after Chair Powell steps down from his chairmanship in May. We did get the release of the new Fed chairman, Kevin Warsh. Has been highly anticipated and will likely be a very good thing overall for interest rates. Not a huge interest rate hawk as far as doesn't really want to promote dropping the interest rates right away, but he is a lot more forward thinking and forward looking. So where Fed Chairman Powell has looked back in the rearview mirror at older reports, the new Fed Governor Warsh would be a little bit more thoughtful in advance of what AI is doing to the job force. Jobs and inflation will remain their top action items. Quick look at the interest rate outlook this week. The 10-year Treasury is down. This was getting close to 4.3%. We'll take a look at the chart, down around 4.2%. We have seen a squeeze or a tightening in the difference between the mortgage rate and the 10-year Treasury, but we're going to focus on this 10-year yield right now just to give a clear picture of what the results were from last week. So in general, we've had an upward trend coming in through the middle of January. We peaked right there at that 4.3% I mentioned, fell off that and kind of hung around this last week, elevated a little bit, and then dropped significantly on Thursday. Started the day off lower on Friday, but ended the day right at the 25-day average, which is where we're hanging right just below that today. We want to see these interest rates come down a little bit. Below 4.2% would be very welcome, but not likely to have any major news to pivot or send the rates in a new direction till we at least this Wednesday. We will get consumer price index on Friday, the inflation report for January. So some news items that could be market moving. Other market news, affecting 10-year bonds, especially for the US Treasuries, is the banks in China have been encouraged to hold less US Treasuries, which they don't hold. I think China in general is less than half of their US Treasury holdings from what they had just say 10 years ago. But that news today did send a little bit of a spike on the 10-year interest rate, and it's since calmed down, hanging around this 4.21, just sandwiched right in between here. So we'll start this week off looking at these, watching for these new reports coming out later in the week, and keep an eye on an update for you and bring it back here next Monday. Have a great one.